Ladies and gentlemen, what if the next big move in gold and silver isn't being driven by the metals themselves, but by politics? Trump's latest statements and policy direction have sparked fresh uncertainty across financial markets, leaving investors wondering whether another major market flush is just around the corner. History shows that when confidence shakes, precious metals often become the center of attention. But is this the beginning of a massive rally, or could gold and silver face one more sharp shakeout before the real move begins? Let's break down what's happening and what every investor should be watching. For years, we've seen one consistent pattern repeat itself in financial markets. When politics becomes unpredictable, capital starts looking for safety. Investors may disagree on political personalities, policies, or outcomes, but money tends to react in a much more objective way. It follows risk, confidence, and expectations. That's exactly why every major political development deserves attention, not because of the headlines themselves, but because of how they influence economic decisions, market psychology, and the flow of capital. Recent developments surrounding President Donald Trump have once again shifted the conversation across financial markets. Whether you agree with his policies or not is beside the point. The real question for investors is how these developments affect inflation expectations, government spending, trade relationships, business confidence, and ultimately the value of the US dollar. Those are the factors that matter when evaluating the outlook for gold and silver. Markets don't wait for certainty. They begin pricing in possibilities long before policies fully take shape. That's why we often see sharp movements immediately after major political announcements. Traders aren't reacting to what has already happened, they're reacting to what they believe could happen next. Sometimes those expectations prove correct. Other times they change rapidly. But the process itself creates volatility, and volatility is something precious metals investors should always pay close attention to. One of the most important relationships to understand is the connection between uncertainty and safe haven assets. When investors become less confident about future economic conditions, many begin reducing exposure to riskier assets and increasing allocations to assets that have historically preserved purchasing power. Gold has filled that role for thousands of years, while silver often follows with even greater price swings due to its smaller market and dual role as both a monetary and industrial metal. However, it's important not to oversimplify this relationship. Political uncertainty does not automatically mean gold prices rise every single day. Markets are much more complex than that. There are periods when investors sell nearly everything to raise cash, including precious metals. We've seen this during previous financial panics, where gold initially declined alongside stocks before recovering much more quickly as confidence in financial assets weakened. Understanding this distinction helps investors avoid emotional decisions during periods of market stress. Another factor worth watching is how investors begin reassessing inflation expectations. Any policy direction that influences government spending, taxation, manufacturing, trade, or supply chains can eventually affect prices throughout the economy. Inflation isn't simply about one number reported each month. It's about expectations regarding future purchasing power. If investors begin believing inflation could remain elevated for longer than expected, demand for hard assets often increases. At the same time, markets continuously evaluate the likely response from the Federal Reserve. If inflation pressures remain persistent while economic growth begins slowing, policymakers face a difficult balancing act. Raise interest rates too aggressively and economic activity may weaken. Ease monetary policy too soon and inflation risks could return. These competing forces create uncertainty, and uncertainty generally increases interest in assets outside the traditional financial system. The US dollar also deserves close attention because it remains one of the strongest influences on precious metals pricing. A stronger dollar can place temporary pressure on gold and silver prices, while a weaker dollar often provides support. Political developments that affect investor confidence in fiscal discipline, international trade, or long-term debt sustainability can influence currency markets in meaningful ways. This doesn't happen overnight, but currency trends often develop gradually before becoming obvious to everyone else. Debt is another issue that rarely receives enough attention. Governments around the world continue carrying historically high debt burdens, and financing that debt becomes increasingly expensive as interest costs rise. Political decisions may change spending priorities or revenue expectations, but they don't eliminate the broader challenge of managing growing obligations. Precious metals investors understand that excessive debt has historically contributed to periods of currency weakness and financial instability. That's one reason many view gold and silver not as speculative trades, but as financial insurance. Silver deserves its own discussion because it often behaves differently from gold. While gold is primarily viewed as a monetary asset, silver benefits from both investment demand and industrial demand. Technologies involving electronics, renewable energy, medical applications, and advanced manufacturing continue requiring significant amounts of silver. That combination means silver can experience larger price swings in both directions. During periods of optimism, industrial demand may strengthen. During periods of monetary uncertainty, investment demand may accelerate. When both occur simultaneously, silver has historically demonstrated substantial upside potential, but also increased volatility. Experienced investors understand that market psychology often changes faster than economic fundamentals. Headlines create immediate emotional reactions, while underlying economic trends develop over months or years. That's why successful precious metals investing requires patience. Rather than reacting to every headline, it's more productive to focus on the broader direction of monetary policy, debt accumulation, inflation trends, currency movements, and investor confidence. It's also worth remembering that financial markets are forward-looking mechanisms. By the time a trend becomes obvious in mainstream media, institutional investors have often been adjusting their positions for weeks or even months. That doesn't mean individual investors should attempt to predict every short-term movement. Instead, it highlights the importance of maintaining a disciplined strategy based on long-term fundamentals rather than daily news cycles. This is precisely where gold and silver continue demonstrating their value. They don't depend on quarterly earnings reports. They don't rely on promises from governments or central banks. They have served as stores of value across multiple monetary systems, economic cycles, and political environments. That doesn't guarantee higher prices tomorrow or next month, but it explains why many experienced investors continue allocating a portion of their portfolios to precious metals regardless of who occupies political office. The key takeaway is not to become distracted by political headlines themselves. The headlines matter only because they influence expectations about inflation, interest rates, government debt, currency strength, and investor confidence. Those are the real drivers that shape long-term trends in gold and silver. Investors who focus on those underlying fundamentals are generally better positioned to navigate periods of uncertainty than those who react emotionally to every new development. Every major market cycle eventually reaches a point where investors begin asking the same question: is this just another routine pullback, or is something much larger beginning to unfold? The challenge is that no one knows with certainty in real time. Markets rarely announce their intentions in advance. Instead, they leave clues through changing liquidity conditions, investor sentiment, credit markets, and the behavior of assets that have historically responded differently during periods of financial stress. One of the biggest mistakes investors make is assuming markets move in straight lines. They don't. Bull markets experience corrections. Bear markets include powerful rallies, and periods of stability can quickly give way to sharp volatility. That's simply the nature of financial markets. Understanding this reality helps investors avoid making emotional decisions when prices begin moving rapidly in either direction. Today's environment contains several ingredients that deserve careful attention. Global debt remains historically high, borrowing costs have increased significantly compared to recent years, and many economies continue facing slower growth while inflation remains a concern. Individually, none of these factors guarantees a major market decline. Together, however, they create a financial environment that is far less forgiving than the one investors became accustomed to during years of extremely accommodative monetary policy. Liquidity is often the hidden force behind major market movements. During periods when money is abundant and credit is easily available, financial assets generally perform well because capital has somewhere to go. But when liquidity tightens, investors begin becoming more selective. Leverage becomes more expensive. Speculative investments lose momentum. Companies dependent on cheap financing face greater pressure. These shifts may develop gradually at first, but history shows they can accelerate once confidence begins fading. Confidence itself is one of the least appreciated components of every financial system. Markets operate efficiently when participants believe obligations will be honored, lending will continue, and economic conditions will remain relatively stable. Once confidence begins eroding, behavior changes quickly. Investors reduce risk, institutions strengthen their balance sheets, consumers become more cautious, businesses delay expansion plans. These adjustments can reinforce one another, creating conditions where selling pressure spreads beyond the original source of concern. That doesn't necessarily mean every market decline becomes a full-scale financial crisis. Many corrections serve as healthy resets, removing excessive speculation before longer-term trends resume. The difficulty lies in distinguishing between ordinary volatility and structural weakness. That's why experienced investors spend less time predicting exact dates and more time monitoring the health of the broader financial system. Credit markets deserve particular attention because they often reveal stress before equity markets fully recognize it. Rising borrowing costs, widening credit spreads, or increasing defaults can signal that financial conditions are tightening beneath the surface. These indicators rarely receive the same media attention as stock indexes, yet they frequently provide valuable insight into the underlying strength of the economy. Investor psychology also plays a critical role. During prolonged advances, confidence gradually transforms into optimism, optimism into enthusiasm, and eventually enthusiasm into complacency. At that stage, many participants begin believing markets can only move higher. Risk management receives less attention. Valuations become easier to justify. Leverage increases. History repeatedly demonstrates that excessive optimism often creates the conditions for disappointing outcomes. When markets eventually reverse, the emotional process unfolds just as predictably. Initial declines are dismissed as temporary. Larger declines create uncertainty, continued weakness generates fear, and fear frequently leads investors to sell precisely when prices have already fallen significantly. Understanding this emotional cycle is essential because it reminds us that markets are driven by human behavior as much as economic data. This brings us to the role of gold and silver during periods of market stress. Many people assume precious metals should rise immediately whenever stocks decline. Reality is often more complicated. In the early stages of a sharp market correction, investors sometimes sell whatever they can, including profitable gold and silver positions, to meet margin calls or raise cash. As a result, precious metals can experience temporary declines alongside broader markets. History provides several examples of this pattern. During periods of intense financial stress, liquidity becomes the priority. Investors seek cash first, regardless of the long-term outlook for individual assets. Once that forced selling begins to subside, attention often shifts back toward preserving purchasing power and reducing exposure to financial uncertainty. At that point, gold has frequently demonstrated resilience, while silver has often followed with even greater volatility. Silver deserves special consideration because it occupies a unique position. Unlike gold, which is primarily viewed as a monetary asset, silver also serves important industrial purposes. During economic slowdowns, industrial demand may weaken temporarily, placing additional pressure on prices. However, when investment demand strengthens at the same time supply remains constrained, silver can recover rapidly and sometimes outperform gold by a significant margin. Another factor investors should remember is that market flushes often expose hidden weaknesses that were building quietly beneath the surface. Highly leveraged positions, overvalued sectors, speculative excesses, and unsustainable business models frequently remain unnoticed during rising markets. Declines reveal those vulnerabilities much more quickly than advances ever do. While these adjustments can be painful in the short term, they often create healthier foundations for future growth. Risk management becomes especially important during uncertain periods. Successful investors recognize that preserving capital is just as important as growing it. That doesn't mean abandoning long-term investment strategies whenever volatility increases. It means maintaining diversification, avoiding excessive leverage, and understanding that temporary price swings are part of every market cycle. One of the greatest advantages individual investors possess is the ability to remain patient. Large institutions often face quarterly performance pressures, redemption requests, or regulatory constraints that influence their decisions. Individual investors who maintain discipline and avoid emotional reactions may be better positioned to take advantage of opportunities created by market dislocations rather than becoming victims of them. Rather than focusing exclusively on whether another major market flush is imminent, investors may benefit more from asking a different question: is my portfolio prepared if one occurs? That shift in thinking changes the conversation from prediction to preparation. No one consistently forecasts every correction, but thoughtful planning can reduce the impact of unexpected volatility. Ultimately, markets will continue cycling between optimism and fear, expansion and contraction, confidence and caution. Those cycles have existed for generations and are unlikely to disappear. The precise timing of the next significant decline remains unknowable, but the importance of discipline, patience, and a long-term perspective remains constant. Investors who focus on sound fundamentals, prudent risk management, and the enduring role of tangible assets are generally better equipped to navigate whatever the next chapter of the market cycle may bring. For anyone investing in gold and silver, the most important habit you can develop is learning to focus on the factors that truly move the market rather than getting caught up in the daily headlines. Financial news is designed to capture attention, and every trading session seems to come with a new explanation for why prices moved higher or lower. The reality is that the precious metals market is driven by a combination of long-term fundamentals and short-term sentiment. Understanding the difference between the two can make all the difference in how you respond to volatility. One of the first things to watch is the direction of monetary policy. Precious metals do not exist in isolation. They compete with interest-bearing assets, government bonds, equities, and currencies for investor capital. When central banks tighten monetary policy by keeping interest rates elevated, the opportunity cost of holding gold increases because gold itself does not generate income. On the other hand, when markets begin anticipating lower interest rates or more accommodative policies, gold often becomes more attractive as investors seek protection against future currency depreciation and inflation. It is important to remember that markets are forward-looking. Gold and silver frequently begin moving before central banks actually make policy changes. Investors price in expectations, not just events. If market participants believe monetary conditions will become more supportive for precious metals several months down the road, prices may respond well in advance of official announcements. That is why watching expectations can sometimes be more valuable than watching the decisions themselves. Inflation remains another critical piece of the puzzle. While inflation rates may fluctuate from month to month, the broader concern is whether purchasing power continues to erode over time. Gold has historically served as a store of value during periods when fiat currencies lose purchasing power. Silver shares many of those monetary characteristics while also responding to industrial demand. Investors should pay attention not only to official inflation reports, but also to trends in energy prices, wages, housing costs, and the prices consumers encounter in everyday life. These factors often influence inflation expectations long before they appear in government statistics. Currency markets deserve close attention as well, particularly the US dollar. Since gold is priced internationally in dollars, movements in the currency can have a meaningful impact on precious metals. A strengthening dollar often creates headwinds for gold and silver, while a weakening dollar tends to provide support. However, this relationship is not always perfect. There have been periods when both the dollar and gold advanced together because investors were seeking safety in uncertain financial conditions. This reminds us that no single indicator should ever be viewed in isolation. Government debt continues to be one of the most significant long-term issues facing global financial markets. Debt levels have expanded dramatically over the past several decades, and servicing that debt becomes increasingly expensive as interest rates rise. While governments have various tools available to manage these obligations, history suggests that high debt burdens often lead to policies that reduce the purchasing power of currencies over time. For many investors, this is one of the strongest long-term arguments for maintaining an allocation to physical precious metals, regardless of short-term price fluctuations. Another area worth monitoring is the health of the broader financial system. Credit conditions, banking stability, corporate earnings, and economic growth all influence investor confidence. During periods when confidence is strong, capital often flows toward growth-oriented investments. During